I'm going to run you through it, run you through the logic, and then I'm going to show you something which we created to make it as comprehensible as possible. So you at a later point can as well start playing with it, because I think this gives you a very, very good idea about things. So we kept the fund configuration, which you can imagine is the core, very, very simple. 15 million fund, we already played with that. We assumed roughly 20% will be fees. Everything you can literally change. So you can jump over here and say, hey, my fund is this and the fees are that. You kind of enter the portfolio size and your entry stage. Yeah, so it could be anything up to Series A. I didn't want to bother because then it gets a little messy and complex, so I spared that one. So the outcome of these assumptions would be 50 million fund, 20% fees. Obviously, I can deploy 40 million. And if I only have an entry strategy, 800K will be the check size distributed in 50 companies, right? Makes all the sense in the world. So the calculations are obviously automatically. And then for the ones which say, hey, I don't have an entry-only strategy, but I have an entry strategy plus follow-on, you can just toggle and say, all right, I'm going to add hypothetical follow-ons, and I'm going to have 5 of them, or 10, or 4, whatever, with a follow amount of that and a success rate of X%. So you define all these things and have the immediate calculations already reflected. I'm going to untoggle this for the time being. And obviously, everything's live. Everything you do, you will see the immediate change. If you don't see it immediate, you run the simulation and then you see it. And then we're going down to the most basic things. What do I think is my assumption on valuation status between pre-seed and sleeping and Series A and so on? And what I mentioned earlier is like, you can already see, like, if this would be the reality, the outcome would be 31x if I would sell the company in Series D. What does it mean in other terms? If I invest 800K, the outcome of a perfect company would only be at 24 million. So half of my fund. Still, it's a fantastic return. If you have one company returning that, it's great. This would change, obviously, if you would have follow-ons, because entry checks go down, but the overall exposure gets up and so on. And then you can define the valuation and ownership. Ownership is obviously calculated by itself, but if you have a pre-money valuation, 6 million euro as an example, and a certain round, then have like the numbers of Steve 40 million, but the round says just 1 million. Then you have the 11% ownership. And now it becomes interesting. We talked about graduation rates or write-off ratios. You can define, depending on your stage, your industry, but how high do I think is the likelihood that I return 1 to 0, like a write-off, or return 1 to 5x or 5 to 10x. And this will give the whole portfolio a channel on where it's moving, right? So, and you have a couple of explanations. If something's unclear, you can always like go on the question marks and everything's explained. So I think it's very intuitive. And now that's where the magic happens. You can create scenarios here, and that's what the purpose, to not only have a scenario and look at it and say, hey, this is cool, it makes sense. That to create 1, 2, 3 scenarios, put them next to each other and kind of see what's the impact of my changes. And try to understand and learn by yourself, if I change this variable and isolate everything else as a constant, then this is the impact. And so I created the default scenario and I created 3 other scenarios, which I will show you in a second after I ran through the whole model. And you can see here, you have like an amount of virtual funds you're creating. So I'll take all the assumptions, and by entering 10 or 1,000, you have 10, 20, 50, 100, or 1,000 simulations of virtual funds with these assumptions. The more you add, the lesser the standard deviation. The less you have, the higher the standard deviation. For obvious reasons, right? So I give you an example. I take exactly everything I did and just look at the median MOIC. If I run 10 simulations, it jumps quite a lot between, I think, a low at 1.4. We had 2.7. So the deviation is quite high. If I run the same model on 1,000 virtual funds, here again, the idea of Monte Carlo simulation, you see the deviation is not that much anymore. So with obviously more funds, and if you can configure companies below that, you literally see that the deviation is getting smaller. Let's go back to the standard model with 50 simulations. And what this shows you is like, if I would have 50 funds with these assumptions, my median MOIC would be 2.3x, which is already a good MOIC. The mean would be slightly higher. The base case, the best performing one would be 6.2x based on all my assumptions. And the worst one is still above 1x. So this is great. It's just a result of like the small subset, but usually it would be a little lower. Then you have an IRR estimate, like a mean median, and obviously like the top 10% or like the lower 10% and the top 10%. You as well.
Can I just interrupt you, Mark, just to add kind of interpretation on top of it?
Yeah.
So with my lens of auditing a fund, I would not look at this fund model. And many fund of funds would not look at this fund model, right? And so with that realization, like that should now inform your exercise of building the fund model. So you need to go back to assumptions. So that's why we say like assumptions are so important. Like we can run thousands. This is not an interesting proposition to a professional LP.
Yeah, true. And here you see a quick breakdown. I said only entry, no follow-ons. This is the fees, makes all the sense in the world. And then you have like a distribution outcome overview. 50 investments, out of this 50, 72 in this case would be like write-offs. Then I have some modest returns, and I even have in this simulation one outlier. So 1% likelihood, which I just hit to have a over 20x outlier. Good thing is in this model, based on that, 50 companies, fairly high investments per company, so 800K, the likelihood to return your fund at least 1x, so no hurdle achieved or whatsoever, you just give the money back to your LPs after 10 years. So net of inflation and interest would be a negative return. You would still get this. To get to a 2x, that's already quite a good number. To triple the fund, so to be a top decile fund, the likelihood is 16%. So actually not too bad. But here again, keep in mind, we're in a very theoretical spectrum, It depends on how good of a picker you are and so on. So these variables are equally or way more important than what the outcome of a Monte Carlo simulation is. But nonetheless, it should show you what the potential outcome based on 1,000 virtual funds would be if you would follow that strategy with these assumptions. And then it gives you like 10 random picks out of the subset, 50, 100, 1,000.
Mark, we got a question about kind of a refresher on Monte Carlo simulation. So this actually, that where you were just now, down there, yeah. So here you can see actually what's happening, because we see 10 random picks, but whatever. You see how each fund has a slightly different distribution of companies across those probabilities, and that's what's running the system in the back.
Exactly. So here again, it's just like to give you a subset of the 1,000 simulations, how they could potentially look like. Because if you have 1,000 virtual funds, obviously the outcome is not linear. It's like always a little bit different, but the average is like it's averaging out.
It's like if you roll the dice 50 times, what would happen?
Yeah, exactly. And if you do this 50 times, 100 times, then you would have still 50 different outcomes, right? But the more often you do it, the more closer are the overall outcomes. The second part is distribution, and this is very interesting. So here again, let's take the example of simulating 10 funds. And as you can see, there's no correlation. Doesn't matter how often I do it, you always have a huge delta between worst case, best case, and the return distribution in terms of TVPI. If I change the simulation to 1,000, all of a sudden you see the pattern. It's not changing much. The pattern is always the same. And this is the idea of a Monte Carlo simulation. At scale, it should show you what the impact of your doing is at scale. At scale, I mean, like if you have 500,000, 10,000 simulations or whatsoever. And this is really cool because it gives you a very good feeling if your fundamentals make sense or not. And if so, what the outcome would look like. Divergence is still high in reality. And if you take then at the probability curve, you say like the likelihood that you at least like return your fund, like, okay, this is 0.8x in this case, is 99%. I mean, it's not going to help you. Nobody's going to sell a 0.8x fund. But you still have a 0.1% probability of creating a 6x fund. It should only give you a feeling. It's a mental exercise. It's not more, it's not less. You can not stress this. It's just assumptions and reality at scale. Yeah. And I added this as well because for some people it's not too obvious. The larger the portfolio, only one thing happens. Keep that in mind. The divergence or convergence between minima and maxima is narrowing. This is the only thing that happens. So if you increase the portfolio, you're just going to be in a more narrow funnel in terms of outcome. If you have 100 investments, it's simply unlikely that you return them less than 1x. But it's very unlikely that you have a 5x fund. But if you have a portfolio of 5 companies, the divergence can change quite a lot. 1,000 is too much to throw this. Oh, Strange that it's not. You see, I found the first bug. But the narrative or the logic behind this is absolutely correct. And now I'm getting to the real thing. And we can play around, or you can play around at some point with this. What I created is like the compare version. So we have this default scenario where I said, hey, it's a 50 million fund, 20% fees, 50 investments, pre-seed, and all my assumptions. And I compared them to different scenarios. A default scenario, which I just explained, a compressed portfolio, a large portfolio, and the third scenario is a follow-on assumption. So I just tick that toggle here. And remember, when I run this, obviously the numbers will change as well. If I move them to 1,000, they will be quite better because my hit rate on my assumptions here, if I change this, you will have different numbers as well. But going back to this one, let's compare. So we have the standard model we spoke about. You have a median return of 1.8x. What is happening if I have a small portfolio? The median return is going down, but what is happening as well is that the downside is lower, obviously, because it's a very, very small portfolio. But on the other side, if I do have a hit in my very compressed portfolio, the upside is twice as much in the top 10% decile compared to a portfolio with 50 companies. So this is cool. What's my take? My take is compressed portfolio, more risk. But if I have a hit, the impact of a single hit is so high that it can double the return. This is my take. This is the only thing you can learn from this.
Can I add a note? Sorry, Mark, just adding a note here. So please bear in mind, after this masterclass, we're going to look at portfolio construction and decomposition. And as Mark said just before, it's where you can add nuance, right? So we're just kind of averaging assumptions. So let's say you truly believe in these assumptions, but you actually have a superpower of a team of GPs, and you know that you pick better than anyone else. In the portfolio construction, you could go in as an example and add that nuance, saying, well, we pick better. That's our superpower. Our track record shows it, blah, 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 blah. And maybe this fund model or this assumption set, Justin, I did use the wrong wording, actually. I said fund model. I should have said this assumption set. The assumption set, which I said was not interesting, suddenly becomes interesting because of that factor, the factor that the team strongly believes they can pick better than average, and then it becomes a 5x fund. Then it's a matter of, do I believe with them that that is true? That's then judgment call, right? But that's an important nuance that we must not forget. Mark said it multiple times. This is a tool for you to use as a GP. It's not the model per se yet.
Please don't sell this to a piece. But yeah, it is just a tool to kind of stress your model a little bit at scale. So this is the first row, like very compressed portfolio. What do you see, which is very important, is the standard deviation. Obviously, as you have a very compressed portfolio, potential outcome is like this, yeah. And this will obviously change and swing exactly to the opposite compared to the default model if you have a large portfolio. So the only thing I changed here is I said it's going to be 150 companies. Still entry only. Nothing else was changed, pre-seed. Obviously, ticket sizes go down, median return goes up. As we know, it goes up for quite a while the more you increase a portfolio. But the downside is quite high, so it's unlikely that you will return less than 1.6x, which is cool. Is this a reason why any LP in the world would give you money? Absolutely not. Yeah, because on the other side, you as well kept the upside. So you will have less upside because your portfolio is so broad that the impact of a single outlier, if you hit the single outlier, is simply vaporizing. It's not vaporizing, but the impact is less. On the other side, you have as well another higher likelihood to have more absolute outliers. So here again, it comes down to what I said here, the convergence. The more portfolio you have, the smaller the funnel between minima and maxima, or top decile and worst decile. And this is what you literally can see here at the very end. The top decile, the P10 and P90, just narrows down the bigger the portfolio. If the portfolio is smaller, it goes up again. And you can as well look at this probability to return 2x, 3x, and so on. But the most important is median, top, bottom decile, and the standard deviation. And then we have the last case, same model again. The only thing which changes is, based on the assumption which we defined, you have a follow-on strategy. And what you can see is happening is, with the follow-on strategy and the likelihood which is defined to hit great companies, which I here again, everybody has to decide for themselves whether they're a great follow-on picker, the median return goes up, which is great. And the downside is probably as good as it is in a broad portfolio. So this is great. You have a higher median return and you kind of protected your downside and you still have a very high upside. So from a Monte Carlo perspective, just on this assumption, it would make sense to have a certain allocation, which is in this case not even big. It's like 15% or something, to do follow-ons, under the assumption that you're right. If you run more, and you can start playing with that and run simulations, that what's the minimum threshold of how often I have to be right within my follow-ons to see when is the exact point when the number drops. And this is exactly an inflection point where you say, am I confident enough to say that on 8 follow-ons, I'm going to be X time right? And exactly, this is more or less it. I mean, I wouldn't call it a super simple tool, but it's a good one to kind of understand the implications of your fundamental assumptions. And the more iterations you do on the simulation, the closer you're going to get to a certain reality. And here again, nothing you send to your LPs, nothing you would be able to use in your day-to-day work, but a good intermediate step towards a model you feel comfortable with because you stressed it on X thousand simulations.
One thing I've also realized, and this is a kind of a dangerous thing to say, but I'll say, we did not build the tool with that intent at all. But for those who are more numeric among you, you can actually fiddle with it to play with your current fund you're deploying to figure out kind of how to sort out like the fact that you raised a bit less, you raised a bit more, valuation is a bit higher. You could use it for that. We did not build it for that. So it's a very dangerous thing to do, but you could actually fiddle with it a bit to inform kind of your decision making.
Yeah.
If you're in that phase of your fund as well.
And the good news is we didn't stop here. We built a second one only to do the exercise with the fund returners, which is, I think, even a little bit cooler. So we will show you this in a later session, but it's pretty awesome. And this will save you like quite some time in your model thinking.
Yeah, so recap of the session, assumption sheet construction, one of the core elements in our modest opinions, probably the most important element or building block of a fund model. As Marc explains, there's like 4 big categories of assumptions. To be frank, there's like 2 that are really the basis, like the structure of it all holds on it. And then the others kind of are inferred with some nuance there. And then this Monte Carlo simulator, if you will, is a tool that you can use to kind of help you in the process of building the assumption sheet, right? In a way. I don't know if there's any questions or Marc, you have any final comments, but I think that's kind of what we wanted to cover today.
No further comments. It's not, but I've not been speaking enough for the past 2 hours. I'm confident that we only need 1 hour until I realize we almost end up at doing the exact 2 hours. Interestingly. So I have no further comments. I hope it gave you some new views on things and that we could convey like the message of what we think are the fundamentals in assumption sheet modeling. And anything which we didn't answer today, we can surely answer in the next 11 minutes or we do so in our AMA.
Yeah, and also I'm preempting possible questions. So we will share the Monte Carlo tool. We think it's an amazing tool for you to use. As I said in the beginning, we're going to ask you, please not to share it. We're actually going to whitelist it. So it's going to make it really hard for you to share because we do want to share it with the whole ecosystem, but we need it's still kind of very early days. You need to test it a bit more and kind of figure out where it breaks. We will not share any Excel template. As we've said multiple times, we don't believe in that. I can assure you that if we did share, you'd have a really hard time using it. And if you could use it, you could probably build a better one yourself. To be very frank, it's easier to build one from scratch based on what we're sharing. We will revisit this Excel model in our upcoming masterclasses. Most of you are part of our cohort, so we'll be coming back to the same Excel over and over again. And by the end, you'll be much more familiar with it. And we're kind of lifting the veil of each bit at a time. Andrew, worst case next week, you'll have access to it. We're going to try earlier, but I'll commit to next week. Yeah, I'm going to try earlier than that. Andrew was asking, when can we get access to this whizzing new MC tool?
And I was pushy enough to write him already, but the answer is bug free. I mean, there's no bugs from the logic. We just want to make it cool. So there might be some small things added.
Yeah. We might add like a feedback button as an example. If you guys find something you can sign it. It's helpful. Yeah. Awesome. Everyone, listen, we first time ever, Marc, 9 minutes to spare. Amazing.
Like everybody saved 9 minutes of life, not hanging out in a call. I hope you had a good time. And if there are any questions in between, let us know.
Yes, exactly. If you are a participant of the fund modeling cohort, I would highly encourage you to review your replies to the assumption challenge we shared, where many of you shared your assumptions. I would love to kind of invite you to rethink them based on what we looked at. I think that would be a great experience. I would also encourage you to connect with each other on the 24th of February. Yes, so that's next week. We have our office hours. So that means that Marc and myself will be available for 2 hours nonstop to cover anything. And in that session, we'll be a bit more flexible and able to go a bit off topic, right? Because we just booked that time for that. So please feel free to also prepare questions for that. If you don't have any questions, you just want to tune in, it's also super cool. If you don't have any questions and you don't want to tune in, well, your loss, we'll miss you. And we'll see you on the 4th of March, which is when we'll go into portfolio construction and decomposition. Yeah. So that's it for logistical warnings. And I hope you appreciate the extra 7 minutes in your calendar. I know I will. Thank you, everyone. Have a great rest of the day.
Have a nice one.